Welcome to The Explainer. Today, we're opening up Crypto's toolbox. Our goal is to give you a simple, clear field guide for this whole new digital economy.
You hear these names all the time, right? And they usually get lumped together under this one big umbrella, crypto. But here's the deal. Thinking they all do the same job is a huge mistake. They are fundamentally different tools built for completely different purposes.
Honestly, the best way to wrap your head around this space is to see it as a collection of specialized tools. Each cryptocurrency is designed to solve a very specific problem. And just like in a workshop, using the right tool for the right job is everything.
So in this explainer, we're going to organize that toolbox for you. We'll cover the three main jobs in crypto, take a look at the key players in each category, and then we'll finish up with the critical risks, including one that could, well, threaten the entire system.
Okay, let's start with the first and probably most famous job in crypto, creating a digital version of gold. A reliable way to store wealth that can't just be devalued on a whim. So when you ask what makes Bitcoin special, a lot of people think it's about lightning-fast payments or some kind of revolutionary tech. But its core value, especially as a potential hedge against inflation, comes from something much, much more fundamental. And that rule is absolute scarcity. This single, unchangeable feature is what underpins the entire digital gold narrative. It's what has attracted billions from serious institutional investors who see it as a safeguard in a world where money can be printed endlessly. This is the number, 21 million. There will only ever be 21 million Bitcoin created. Ever. It's not a policy that can be debated or a target that can be changed by some central bank. No, it's a mathematical certainty. And that predictable scarcity is its killer feature. All right, let's move on to the second major job, creating a global, decentralized computer. We're talking about a platform for building unstoppable applications, everything from finance to gaming. And this is where we find one of the biggest philosophical debates in the entire industry. You see, the central challenge for any world computer is this idea of scalability. How in the world do you handle millions of users and transactions without getting ridiculously slow and expensive? Well, the two biggest players, Ethereum and Solana, have come up with completely different answers to that question. Ethereum's approach is what's called modular. Think of its main network as the super secure foundation. Then, to handle all the traffic, they build dozens of separate, high-speed highways, called Layer 2s, on top of it. Solana's approach is monolithic. It's trying to build one single, massive superhighway that's fast enough for everyone all at once. And this just illustrates the trade-offs perfectly. Ethereum's layered approach is powerful, and it inherits this incredible security, but using it can feel a little complex, kind of like moving money between different bank accounts. Solana, on the other hand, gives you this seamless, single-layer experience with fees that are just fractions of a penny. That makes it absolutely ideal for things like gaming and high-frequency trading. Now, what's really fascinating here is the hidden cost of Solana's speed. To run a validator, that's one of the computers that helps secure the network, you need incredibly expensive, specialized hardware. This means you end up with a smaller, more centralized group of validators. Compare that to Ethereum's vast global network of over 1 million, which can run on much more accessible hardware. It's that classic trade-off, speed versus decentralization. Let's shift gears to our third and final job, creating a true replacement for cash. I mean, for a crypto to be useful for buying coffee or paying for groceries, it has to solve that massive problem of price volatility. No merchant wants to accept a payment that could be worth 10% less an hour later. And the answer is stablecoins. These are digital tokens, and they're usually pegged one-to-one with a stable asset like the US dollar. So you get all the benefits of crypto, fast, global, digital transactions, but without the wild price swings. It makes them perfect for real-world commerce. And this isn't just a theory, it is happening right now. If you look at a major business hub like the UAE, stablecoins already account for 2/3 of all on-chain transaction volume. Businesses love their stability for everything from cross-border payments to local commerce. And stablecoins are just one approach to creating digital cash. You've got other specialists tackling this from different angles. You have assets like XRP, which is laser-focused on the banking world, built to settle cross-border payments in seconds instead of days. Then you have others like Litecoin and Bitcoin Cash, which are more focused on us, the consumer. They were designed to be what Bitcoin originally aimed for, a faster, cheaper version for everyday purchases, kind of like a digital silver to Bitcoin's gold. So we have our three categories: digital gold, world computers, and digital cash. But, and this is absolutely crucial to understand, we are still in the very early days, and this technology comes with significant, undeniable risks. All of these assets share some pretty major risks. We've seen market-wide price swings of over 80%. Unlike a bank, there is no fraud protection. And most importantly, user error is permanent. If you lose your private key, your password, your money is gone, forever. There is no forgot password button. But beyond those risks, the entire crypto space faces a common, almost existential threat. It comes from a new type of technology that could, in theory, crack the very cryptography holding this entire ecosystem together. Today, the system is secure. I mean, even the world's most powerful supercomputers couldn't brute force a Bitcoin wallet if they tried for billions of years. But the concern is quantum computers. While they aren't powerful enough yet, experts believe they could pose a real threat sometime after 2030, which has kicked off this huge race to upgrade the entire industry to new quantum-resistant security standards. So, the crucial point is this. We're moving past the debate of if this technology will matter. The digital economy is being built, piece by piece, right now. The real question is which of these specialized tools, the digital gold, the world's computers, or the digital cash, will be the ones chosen to build the future. Understanding their jobs is the first step to navigating what comes next.